Hello students, today we are going to solve a problem on ratio analysis. Okay, in this particular problem, the financial statements of Evergreen Limited are given. So here the trading and profit and loss account as well as the balance sheet is given, using which we need to calculate certain ratios. Okay, for this particular problem, I have given the file in the classroom app. You can refer the file, the problem, which is having solution as well for your reference, for your better understanding. Okay, see, this is the profit and loss account, and this is balance sheet. Okay, here they are asking us to calculate the gross profit ratio, operating profit ratio, operating cost ratio, stock turnover ratio, liquid ratio, and debt equity ratio. So the income statement and the balance sheet are going to be rearranged for our convenience. Otherwise, while calculating the ratios for each specific item, we need to do many working notes. For that reason, when P&L account is given, when balance sheet is given, for our convenience, for our requirement, if there is only requirement, then only we are going to do rearrangement of those particular statement. So with the help of that P&L account, trading and P&L account, I am creating a rearrangement. I am creating a statement for income statement. So, okay, here the sales is rupees 10 lakh. In that, cost of goods sold is reduced. That means in the cost of goods sold, opening stock plus purchases minus closing stock plus direct wages and manufacturing expenses, other variable expenses, other direct expenses I am adding, we need to add here. So you will get cost of goods sold. So this cost of goods sold is reduced from the sales, you will get gross profit. So after gross profit, any operating expenses will be reduced, that is rupees 1 lakh. So administrative expense is rupees 50,000, selling expenses is rupees 50,000. So total operating expense is 1 lakh. So in that gross profit, I am reducing the operating expenses to arrive at operating profit, that is rupees 4 lakh. And here the operating cost, here I am not mentioned this particular item. So operating cost is going to be these two items. So that is cost of goods sold plus operating expenses. So operating cost is going to be rupees 6 lakh. Now to the operating profit, we need to add non-operating incomes. So if there is any non-operating income, so we are going to consider those non-operating incomes. Non-operating incomes means, so which are not directly related to the business activity. Okay, so profit on sale of shares. So these shares may be related to some other company. So when we sell those shares, we may earn some profit. That particular profit is non-operating income, that is not directly related to the activity of the business. So that is 50,000. Now the profit comes to rupees 4,50,000. So here this is 4,50,000. In this 4,50,000, again non-operating expenses, if anything is there, non-operating expenses, we need to reduce those non-operating expenses. Here one non-operating expense is there, that is loss on sale of plant, that is rupees 25,000. So after reducing 25,000, we come up to rupees 4,25,000. So this is profit before interest and taxes, that is 4,25,000. In this particular amount, we need to reduce interest and taxes. Here taxes in this particular problem, tax amount is not given. So interest on debenture is 10,000 rupees. So net profit after taxes, after interest and taxes, is going to be 4,50,000. In the same manner, we also need to rearrange the balance sheet. Here we need to consider the capital and liabilities first. In that, equity share capital, preference share capital, reserves. So if we are going to add all the three items, so that particular total is going to be called as equity or otherwise shareholders fund. Okay, and if there is any profit from the balance sheet, so which is not transferred to reserves, so that particular profit is also considered here as a equity item or shareholders fund. Okay, and after which I am also adding some liabilities, so which are long term liabilities. So long term liability, only debenture is there, so debenture is rupees 2 lakh, so which is added to the equity. So total 5 lakh is capital employed. So this is the continuation of the rearrangement of the balance sheet. So after that, assets are going to be considered. In that, fixed assets. So fixed assets, land and building, plant and machinery, furnitures are going to be considered separately. Total fixed asset is 2,50,000. If there is any investment, that is going to be considered separately. Here in this problem, no investment is there. And after which, current assets. So in that current assets, if any current liabilities are there, that is going to be reduced. Okay, that net current asset or working capital is going to be considered here. So current assets are bank balance and debtors, that is rupees 50,000, and that is 1 lakh. So total 1,50,000. So these are liquid assets. Liquid assets means that can be converted into cash immediately. That can be utilized for any liability for the company immediately. So these are going to be called as quick assets or liquid assets. And stock is also a current asset which is added later. So here to the liquid assets or quick assets, I am adding stock. Stock is 2,50,000. So total current asset is going to be 4,50,000. In this particular 4 lakh, sorry, this is 4 lakh rupees. So in this particular current asset, I am reducing the current liability. Current liability is creditors, bills payables, that is 1,50,000. 1,50,000 in the total current liability. Here there is no bank OD, so which is going to be considered, which is not going to be considered in quick assets. So for that reason, in this particular problem, the current liability and quick liability both are rupees 1,50,000 only. So the net working capital, the net current asset is going to be 2,50,000. So if you are going to add with the fixed asset, the capital employed is also going to be rupees 5 lakh rupees. After the rearrangement of income statement and balance sheet, we are going to calculate the ratios. The first one is gross profit ratios. These ratios are shared with your in your classroom app. Okay, so the formulas for different ratios are shared, and also related interpretation are also given in that particular file. You can refer those information for better understanding. The first one is gross profit ratio. Gross profit ratio is calculated with the help of gross profit and net sales. So gross profit in the problem, that is we have calculated rupees 5 lakh, and the net sales is rupees 10 lakh. So gross profit divided by net sales, 5 lakh divided by 10 lakh into 100, you will get 50%. Okay, next operating profit ratio. This is also calculated in the problem. Operating profit is rupees 4 lakh, net sales is rupees 10 lakh. So operating profit ratio is 40%. Operating cost is also calculated, that I have shown earlier. So 6 lakh is the operating cost. divided by net sales, that is into 100, which is going to be 60%. So this particular operating cost can also be calculated like this. Operating cost ratio is equals to 1 minus operating 100 minus operating profit ratio, that is 100 minus 40%, you will get 60%. Next, the current ratio. So current ratio is, which is very familiar with you people. So current assets divided by current liabilities, that is 4 lakh divided by 1,50,000, 2.67 is to 1 is the current ratio. So in the interpretation part, we are going to say that the liquidity position of the company is good. Okay, then quick ratio is liquid or quick assets divided by current liability, 1,50,000 divided by 1,50,000, which is equals to 1 is to 1. Okay, and then stock turnover ratio, cost of goods sold, which is calculated in the rearrangement of income statement, that is 5 lakh rupees. Then average stock is opening stock plus closing stock divided by 2. Opening stock plus closing stock divided by 2, that is 1,50,000 plus 2,50,000 divided by 2, you will get 2 lakh rupees. So that average stock is used to calculate the stock turnover ratio. If average stock is not given, in that case the available closing stock or opening stock is itself is going to be considered here. Okay, so 2.5 times. Then debt equity ratio is debt divided by equity. There is only one debt amount, long term debt, that is debentures, that is 2 lakh rupees, and divided by equity. Equity is rupees 3 lakh. Equity is shareholders fund. Equity is not equity shareholders fund or equity share capital. Equity means this is shareholders fund. Okay, so 0.67 is to 1. Okay, you need to solve similar problems, like we have solved earlier, so which is going to help you understand how to solve problems on ratio analysis. Okay, thank you.